Hi guys, welcome to Investing with JYK, and today we'll talk about Cameco and see where the upsides and downsides are. So I've already made a video on Cameco, which is a uranium miner, a while ago, but in there I didn't really discuss in depth like how much the upside or the downside is. I mean, I kind of did, but like not why. So here we can start looking at it, okay? So first of all, these are the current numbers. You can find it in the annual report of 2017. Oh, oops, here we go. Right. So the average realized price is this number. So that's how much they got actually with for their uranium. And the cost of production, I basically just took this number here, which is actually, let's see. $41. Here, including, yeah, so this is the actual cost, but this is in Canadian dollars, so I have to convert that to USD. So that gives us something like 28, yeah. So this one is like gonna be 28-ish, but if you take the 2016 number, then it will be something like, you know, I think this is the 2016 number, but it's somewhere there. It's not. It doesn't really. Oh, 28. Yeah, it's this guy. So it's like 28.31. It's not too much different. It's like $3 difference, and it also depends on whether Cameco got it from mining or did they get it from purchasing from spot. At the moment, if you buy from spot, it's like 27, but in 2017 they were able to buy spot under 22. I think it was like always under 22, and they were basically buying on spot and selling into the contract. And here, just to remind you, there for uranium, there's the spot market, which isn't very active, and then there's the contract market, which is usually higher, and then they last like five years or more. And production number, they were planning to produce 30 million pounds in 2015, but things went, like price kept on dropping, so they actually did not produce as much. But I think that's their capacity. Obviously, they have now shut down McArthur River, but it should be able to restart that operation within a year or so. So that's so no more exploration. They just have to restart the mine. Most of the infrastructure is there. So that is that. 2017 net income was negative 205 million Canadian dollars, and then for USD is 160. And here's the market cap in USD. Now, the way I'm trying to do this is I'm trying to come up with three different scenarios. One is if uranium is barely profitable for even the low-cost miners. Second is uranium is barely there to incentivize new production. And then the third one is when people go crazy and start scramble for uranium. Right, so these are the numbers. I think we will not see $20. So this should be the lowest number. Because there aren't that many mines that can do it at under 40 and still cover like depreciation, amortization, and administrative costs. Even Cameco will just be breaking even, and they have one of the highest ore grades. Obviously, they operate in the Athabasca Basin, which has poor infrastructure and all that stuff, but still it is the one of the, I think, either the highest grade or one of the highest grade producers. So this number is basically how much more revenue they would get for $30 million. Sorry, 30 million pounds. And the additional revenue basically will all turn into profit, except cash. So in this case, except taxes. So in this case, that will just make it break even at 0. So if you look at these two numbers, basically when you add them up, that gives you 0. So at 40, they would break even. And for break even, I think that's like the worst case scenario. I mean, when the biggest producer of uranium is barely breaking even, I think that's like the long-term absolute worst case for an industry. And it's not sustainable as well, but let's say that happens, right? That means there's zero income, and for a zero income company that has a potential upside, it has at least option value. And then let's assign just 1 PB to that. That would give them something like 3 point, I think currently they're like 1.2, 1.3 PB, so they will lose another 20% from here. And that would equal to about $9. Now the second scenario is about $60. So that should be, I would say, fairly conservative, but very realistic. In 2 years, the thing goes to $60, and that will make Cameco profitable and potentially some other companies also profitable. Now, some other companies, being people like UEC or UUU or a bunch of these guys, but it is not enough to get a bunch of exploration going on. Some might happen, but it's just not high enough price at $60 if you look at the production cost levels. And the blue sky scenarios, let's say it's going to be $100. But at 60, let's look at the numbers, right? So that will be $400 million in net income. And if you assign a PE of 15, it's going to be $6 million. So that's a double. That's the very probable scenario. And at 60, it can potentially more than double. So let's look at, let's say, why that is, right? So in 2011, their average realized price was $50. And if you go back here, the average realized value, the projected average realized value is going to be 55. So it's actually going to be higher than what it was in 2011, and in 2011 this thing was much higher in price. The company was lower in production and higher in price. And let's see, oh, whoops, wow, the lag. Okay, look at 10 years, 2011, they're at about $40, and they have lower production. If you look at 2011, the production, I think, was half. Production. Yeah, production volume is 22 million pounds. And as I said, it is very likely that they will be able to do 30 million pounds if they wanted to at the moment, because in 2011 they still had the problems with their Cigar Lake mine, and so now they can probably ramp it even higher. All right, so depending on how you want to value this, if you value this with just PE, a 15 PE means it's a double. If you try to match it to 2011, then this stuff should be something like $40. So that's a 4-bagger from now. Currently it's like 10, I think, 11, whatever. And if you go to the $100 scenario, their net income would be 900 million, subtract the taxes, but they, I think, have some loss carry forward. But anyways, it's going to be something like maybe 700 million. And if you give it again a 15, or when people go crazy, they might get higher. But let's say it's 15, and you multiply that by 700 million, so you get 10 billion. So that's a 3-bagger, basically, if you use a PE. But when people go crazy, they go more than PE, so they always over speculate. And in that case, if you consider what happened in 2011, you're gonna end up with something like, back then it was the market cap is 4 times what it is today. So the market cap was something like 15 billion, and it was earning, look at the 2011 number, it was only earning $450 million, or maybe like 500. Let's say 500. So if you do 500 and was 15 billion. Right? So really it's a 30 PE. So if you ever get a 30 PE, this stuff will go crazy. You will go something like 700 to 30 PE, then you got 21 billion, and that is close to 10. Well, 21 divided by 3830, it's like 5.5. So it has a potential to become a 5-bagger, and that is what I expect of this. So the the biggest downside I see is going to be 20%. The upside is going to be 5.5, and it's not unlikely. I mean, this number, you think $100 is more than 4 times. Well, not the more. It's about 4 times the price as now, but it is not as ridiculous as it sounds, because if you extend this stuff to like 1998. You can see it did go like completely berserk in 2007. And from 2007 to now, there's been mild inflation. So really $136 in $136 back then is probably something like $100 now. Right? Oh, sorry, I'm going crazy. I meant $100 now is probably like I'm going nuts. $100 then, which is somewhere here, is probably like $136 now. So this stuff may be something like $170 now equivalent. So it's not as crazy as you may think. Yeah. Obviously, this bear market hasn't been as long as the older bear market. So if you go all the way back, you can see this stuff has really been killed. It's been like just dead the entire time. And then it had a huge rise. So this bear market is not nearly as bad. So maybe it won't go nearly as high, but again, it's not unheard of. And that is my thinking on CCJ, and yeah, hopefully it can be useful. Let's see if we can do max, and maybe 2007. What was it at 2007? It's $50 in 2007, but it had a much smaller production in 2007. So now the production is bigger, so if we ever go there, this thing is gonna go more than 5x. Maybe it goes like to $60 or more. You never know. All right, that was it, and see you next time.